So year to date through the end of the third quarter, the S&P 500 was down about 24%. And the more growth-oriented NASDAQ index was down a little bit over 30%. So we've obviously seen quite a reversal in direction over what we experienced in the immediate wake of the pandemic. One of the things that you can draw some comfort from is the fact that we have a very risk-averse approach. All of our companies have very strong balance sheets. Rising interest rates don't necessarily affect their margins because they don't have much debt to begin with. They're strong cash flow generating companies, companies generally at attractive valuations, and companies that have a history of management integrity and management competence in running their businesses over a long period of time.
The third quarter of 2022 saw exacerbated fiscal threats brought about by pervasive high inflation, energy supply constraints, and ever-increasing debts and deficits among the world economies. The reversal of central bank accommodative measures, along with higher rates, increased volatility, and are bringing about tighter financial conditions, introducing headwinds that we haven't seen in years. It's very likely that investment assets will continue to experience volatility, and as such, we have positioned our funds to be very defensive and to try to protect investors against the volatility that we see going forward. Both the Bond Income Fund and the Short-Term Bond Fund reduced their durations year to date. The Bond Income Fund reduced duration by more than a year over the course of this year to 8 years. The best performing bonds were those with relatively short duration, while the worst performers had longer durations. The Bond Income Fund has been focused on buying securities with higher coupons to stabilize the price.
Well, the Fed has been raising interest rates pretty aggressively this year. It's maybe the most aggressive tightening cycle since the 80s. And one consequence of that is on earnings of certain sectors in the stock market, particularly technology and other areas where there was a lot of long-term growth potential. So with interest rates being higher, the opportunity cost for that growth becomes higher, and investors are probably rationally less willing to pay up for a long growth runway when they can earn money right here, right now. You know, the 1-year yield at the end of the quarter on US Treasuries was 4%. And a year ago, it was closer to 0%. So if you can earn money risk-free for just a year at 4%, then the earnings runway for 20 or 30 years out, potentially for some more startup-oriented technology company, is probably a lot less attractive.
While we lack the hubris to claim we predicted this year's events would unfold the way they did, we acknowledge that in many ways the writing was already on the wall. For much of 2020 and 2021, the COVID pandemic really covered up geopolitical risks that were front of mind in 2019. And Russia's invasion of Ukraine has shown that these risks are squarely back on the table. At the same time, when the pandemic first hit, governments and central banks rushed to keep economies afloat, and they flooded those economies with fiscal stimulus and monetary stimulus. And at the time, we weren't so concerned with these issues, as we were more concerned that the pandemic would bring economies to a halt. And now we're paying the price in many ways for a flood of fiscal and monetary stimulus. And where we've seen that hit is with inflation. In addition to the geopolitical and inflationary concerns, a surging dollar, while good for American companies, puts the brakes on the global economy. The combination of strong commodity prices and an expensive dollar makes further growth very expensive. Ominous though this may be, the market has digested a significant amount of risk this year. And while further volatility is likely, we also note that timing entry and exits of markets is an incredibly difficult task, and one that's generally led to destruction of value rather than the creation of value.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit sextantfunds.com or call 1-800-728-8762.